Okie dokie. Good afternoon, everybody. Welcome to today's webinar, America Saves Week 2022, Making Smart Money Moves to Boost Your Financial Wellness, presented by Next Generation and DeFries Financial. I'm Erica Figueredo. I'm the marketing specialist here at Next Generation. And before we get into today's discussion, I just want to review some housekeeping items and tell you a bit about Next Generation. So as always, today's session is being recorded for anyone that didn't get a chance to make it live. And for those of you that are here live, welcome. It's nice to have you. All of you joining today's session will be automatically muted for the entirety of the session, but that doesn't mean that we don't want to hear from you. So I'd like everybody to take just a second, view your Zoom control panel on the bottom of your screen. You'll see a chat bubble and a Q&A bubble or a questions bubble. So general conversation can go into the chat box. And if you have any questions, please use the questions box. If you are here with us live, please introduce yourself. Tell us where you're from, what you're looking to learn, and anything else that we may feel is important. So for today's conversation, we have our co-host, Dominic DeFries. He is a financial services professional at DeFries Financial. And alongside him, we have our very own Brittany Melville, Next Generation's Director of Marketing and Sales. And we'll get to a bit more about them in just a second. So first off, I'm just going to tell you a bit about Next Generation. So Next Generation is a custodian and administrator for self-directed retirement plans. And these plans are much like the plans that you would find at a brokerage like Fidelity or Charles Schwab. The only difference being the types of investments that you can include within the accounts. So at Fidelity or Charles Schwab, you'd be able to invest in publicly traded assets like stocks, bonds, mutual funds, etc. Here at Next Generation or another custodian like us, you are able to invest in alternative assets. So things like real estate, private equity, cryptocurrency, a lot more, but those are just a few of the popular ones. To give you a little bit of background, we have two main arms of our business. We have the administrative arm and headquarters, Next Generation Services. Next Generation Services handles all of the back office administration, record keeping, mandatory tax reporting, and transaction support for all of our client accounts. And Next Generation Trust Company, located in Sioux Falls, South Dakota, is a licensed and chartered trust company which serves as custodian for all of our accounts. And just to give you our very necessary disclaimer on what we don't do, Next Generation is not a bank or fiduciary, so we do not provide any financial, tax, or legal advice. Next Generation also does not endorse, recommend, or review the merits of any investment or investment sponsor. And so any information provided on today's webinar is for educational purposes only. So now I'll hand the floor over to our hosts for some brief personal intros. So Britt, why don't you tell us a bit about yourself?
Sure. So good afternoon, everyone. I think it's afternoon for most of you. I'm Brittany Melville, our Director of Marketing and Sales here at Next Generation. I've been with the company for almost 5 years, which is insane to think about. And our team is tasked with helping investors educate themselves and about using IRAs to invest in alternative assets. And then we also assist with onboarding, the account setup, and then facilitating some of the funding and transaction processes. So happy to be here today with Dominic and look forward to the discussion.
I was muted. Thank you, Brittany. Now over to Dominic. Why don't you tell us a bit about yourself?
Perfect. Erica, Brittany, good to see you guys. My name is Dominic DeFries. I'm the owner of DeFries Financial Solutions. Where Erica made a comment about the fiduciary, where Next Generation is not the fiduciary. I am the fiduciary. My job would be to work with clients and put together portfolios that would hopefully take them from the beginning, the planning stages of their lives, all the way through the retirement stage of their life, in addition to the distribution phases of their lives. My job is truly just really simple. I listen to the clients, and then we try to make sure that whatever their goals are, and that's what kind of the conversation with financial literacy is going to be about. What are their goals, and then how can we achieve them? But we always start with where we're at today, and that's why my conversations usually don't, I say, take very long, because we all know where we're at today. We all have a very good idea. And we have a good idea of what our goal is. We're just not quite sure how we get there. That's where my job is really becomes more important. I make sure that I understand and design a method that could get you from beginning to the end.
Thank you, Dominic. Now I'm going to hand the floor back to Brittany for today's discussion. Take it away, Britt.
Thank you, Erica, and thanks for your help in setting all this up. All right, Dominic, we're just going to have a discussion. And of all days to be doing this webinar, there's quite a bit going on in the world today. So I thought maybe we could start with a commentary on kind of state of the market, latest with inflation. And I know that I'll preface this by saying I know there's a lot we don't know right now. But can you kind of just share with us, the latest on what's going on market-wise?
Brittany, that is the tagline of the day. You guys can't hear this or see this, but I'm watching Bloomberg, the market channels. It's unfortunate what has happened, if you will. So we'll take that moment to say, hopefully, prayers for everyone that's out there and dealing with that. But at the same time, there is the reality that on our side, it sent the market into a frenzy. The futures were already posting last night at about 800 points down. And if I'm looking correctly, we're still at about 800 points down in the market. What does that mean for everybody? It means we're down 2%. That's not to gloss over the market, but it is meant to say we're down 2%. And we don't know. We just don't know. We don't know where this will stop. We don't know when this will end. We don't know. And when I say stop or end, I mean, we just don't know how far this invasion may last. We also don't know what the actions are going to be from the United States or from the EU at this point in time. There are set speeches to go on sometime later today. And I'm assuming even tomorrow into next week, when we sat down and had a brief discussion about this, inflation was the talk of the town. Where are we going to go with that? It's taken a back seat, obviously, but it's not going to take a back seat. And here's why. We're still about 3 weeks away, and the Fed has not considered moving their dates as of now in having their discussions. And when that happens, we need to be ready and aware of what the Fed will do in relation to inflation. They said they will hike up rates. That's not a bad thing, but it's also something where it could be in contrast to what we've understood, which is when you hike up interest rates, you're obviously trying to fight inflation. So you're trying to obviously slow it down. That could, in conjunction with what's going on today, could really hamper, and we could see even higher inflation. It's a possibility, but we want to make sure that our folks are aware, my clients are aware that we're watching this heavily over the next over the next 3 to 5 weeks. We're not leaving this. It's going to be a day-to-day thing. This post is going to move, if you will, from one piece to the next piece.
So like you said, it's just understanding kind of where we're at. And even if where we're at is we don't know what's going to happen, that's where we're at.
That's where we're at. And that's not a bad thing because we understand, right, from this perspective, what has caused this drop. So that's a good thing. It's more concerning when we have a drop and you have no idea what has caused it. Today, we know what caused it. It's going to be what may get us going again is where we have to figure that out because we don't want to have this continue. But at the same time, it is a current possibility that we just don't know where it will end.
Got it. So pivoting from that to the subject of financial literacy, which is the main focus for today's discussion. For those that are with us today, can you just start by defining financial literacy, and then how do we know where we stand as individuals with respect to financial literacy and evaluate our own?
And so there's several definitions of financial literacy out there, but the idea becomes this: financial literacy is an understanding of fundamental skills, financials, fundamentals, if you will, that you now also know how to effectively use when it comes to personal financial plans, budgeting, and investments. It seems simplistic. What we found, or what we continue to see, is a lot of that general information is just not known, right? Some of the rules we'll talk about to a certain extent when it comes to like a 50-30-20 rule, things like that, Rule 72. These are common things that have been around for years. There's nothing new. If you Google them, you'll find them. But these pieces really are the foundation for setting yourself up, regardless of what happens in the market, right? Because we're always going to expect this to happen, right? But we always have to remember, even in the market, we're still returning over 50 years, 60 years of history, still an average of about 10%. That's not bad. That's not a bad thing. There have been times when it's been more, and there's times obviously when the market has retracted a bit. Last time being 2008, we saw that go down to about 28%. But if you get the fundamentals down, where am I going? Where am I going? Where am I at? Where am I trying to go to? And understand, how does that impact my budget? How's that going to impact my investing? And that investing bubble, we'll talk even more about, it's just encompassing of many things. It's not just one thing. And that's specifically now, it's not just one thing. Years ago, investing was just a stock. That's all you had. You just you bought a company, you had stock, and maybe you had businesses that were considered investments. Today, there's far more vehicles. And we'll talk a little bit more about that as we progress.
Sounds good. So you mentioned budgeting. Do you have any, and that could be, I imagine, a big piece of financial literacy and the planning process. Do you have any tips for budgeting and general guidelines that one should typically follow? Because I know, like you mentioned before, it's almost with some of these things, like we don't know what we don't know. And as you said, these things have been out there, and if someone Googles them, they'll find them. But a lot of times we don't know what to Google. We don't know where to start. So sometimes having experts like yourself or some guidance from someone to kind of guide us in the right direction in terms of what to look for is helpful. So from a budgeting perspective, what guidelines can you share?
There's a couple of guidelines that I do want to dive in, because they are really the core pieces for me whenever I do a financial literacy course. And that first one is a rule. It's the 50-30-20. What does it mean? So 20% is going to go into savings. Whatever your income is, monthly income, 20% you're going to try to put to savings. Let me be very clear. The rule is the rule, but there's like the guide of life. You have to progressively get there. I don't want anyone to jeopardize their own financial situation. And again, this is not advice, it's just the rule and what it explains. But they say 20% should go into your savings account. The next 30%, that's going to cover your wants, okay? We want TV, streamline. We want a cell phone, because then back in the day, we had a phone in our homes, okay? So there are some distinctions in there, but those are some of our needs, right? That are our wants, excuse me. Needs, I need food, I need shelter, I need transportation. That's that 50% of that money that you bring in is gonna stick to those core items right there. You can go even further down into that and really start to dissect it, which I typically do with my clients. We start with the 50-30-20, and we say, okay, well, we're going to earmark 20% right into savings. Where does the remaining 80 go? And you start down the line, 30% for a home, 15% for transportation, roughly 10% for food, another 10% for debt. Yes, you will have debt, and we try to understand it, but you just don't want the debt to be so far reaching that is now consuming more than that 10% of your actual income. And that's usually where that mistake starts to happen. We utilize debt by usually using it and then paying it off on a monthly basis, meaning you used it that month, you pay it off. When you start to use it and then use it and then use it and pay the minimums, now you understand why you're carrying so much more debt. It's something where when debt was first established, it was meant to be used and then paid off, used and paid off, not continuously using. Doesn't mean we won't do it. It just means that you must have a plan to say, how long am I going to hold myself to this line to where I'm actually paying someone 10, 15, 25, I've seen as high as 32% in regard to interest rates on these credit cards. So it gets very expensive very quickly for a lot of people, okay? And then you go to household items like we talked about, cell phones, streaming lines, things of that nature. And then I always add in a personal piece. That personal piece that's like my 5%, right? We do a lot of stuff. We're all great people, but we still do need a sense of self, right? And if you kind of allocate all your funds to all these buckets and forget a little bit of just a piece for you on a monthly basis, going out for a drink, going out for a meal, hanging out with a friend or two, seeing a show, it becomes very hard to progress through a 12-month cycle. It just becomes very difficult. And these are the pieces that help keep us grounded. And you need to make sure that in your budget, you place it in your budget. So that's why we start with that 50, 30, 20. We key in on the 20 and we start to break down the remaining 80 into these buckets, if you will.
Got it. So you shared some really helpful guidelines there. Do you have any specific resources available that someone could reference
Yes.
to look at?
Yeah, so we have obviously sheets together for individuals and obviously points on websites to say, okay, I want to at least take a look at it, Dominic. We just need to understand a little bit about our own personal budget. So yes, at Freeze Financial, we provide some literature behind it as well as functional fact sheets to help you progress your own budget, if you will.
Okay, thank you. Yeah, that's helpful. I think a lot of people would appreciate access to that kind of a resource as a guide. I know it can be easy to kind of conceptually be like, yeah, that makes so much sense. Like I'm definitely going to do that. And then, without having some kind of hard, worksheet or document or whatever to kind of keep us honest, it can be easy to kind of let that slide.
That's where I always like to try to say the true professionals out there, those that say they are fiduciary responsible, that's our job. Our job is to make sure that we help, number one, set it up, but we also try to keep you honest. It's going to happen, right? It's going to be one of those things where sometimes you do need that financial, I like to say, coach at that point to say, how's it going? What's going on? Where are things at? Once you kind of develop those habits, though, where maybe you had them, maybe they need to be strengthened, maybe you didn't have them. But once you get in a routine, all of a sudden you feel it. And the nice thing is as you feel it because you start to see it. You start to see the savings increase. You start to see maybe the debt go down. You start to see, there is a plan behind 1, 2, and 3. I'm not just paying my money, I hate to say aimlessly, but I'm not just paying it and seeing, okay, it's just a payment to me. It becomes a drag. And hopefully as you work with someone, you begin to feel like, okay, this is much more manageable, because this is one of those items, unfortunately, when you look at statistics, that really will break up families faster than anything else. I'd like to say, hopefully these little pieces that we can put together in particular help.
Yeah, it takes work and it takes commitment and communication, but it goes a long way.
Great. It does.
So we talked about budgeting and overall just planning conceptually. Let's shift gears into more specifically retirement planning. This is like we could probably just do a whole webinar on this, I know. There's so much to think about, right? And to learn in terms of like the types of accounts, the benefits to each, the implications of each, taxable and non-taxable, but without getting too much into the weeds for today's conversation, what do we need to think about just generally with kind of where do we start with thinking about retirement planning? And then what are some of the different stages that one might go through and some of the different vehicles, if you want to touch on maybe a few, that can be utilized for that?
No, Brittany, the idea is, we kind of run into those worlds of you can get taxed today, taxed tomorrow, or not taxed at all, right? Those are the kind of the bubbles. And when we say getting taxed today, we're looking at individual accounts. We're looking at something that you've set up maybe at a brokerage account, if you will, of some sorts, and you're trading, I don't know, in and out of stocks and things of that nature, right? That tax later is that notion of, you probably have this at a job if you have a W-2. It's called a 401k, or potentially it's a 403b. Those items are there. Those are retirement designed items, meaning they're not going to be taxed until you touch the money, but they want you to keep the assets in there and let them grow until 59 and a half. At 59 and a half is when you can access these funds without any penalty, but you will pay the taxes at that point, right? Items such as self-directed IRAs come in my mind, SEP IRAs come in my mind, if you will, as well. Take it one step further and going with the notion of, now you're looking at no taxes, Roth IRAs, right? After tax implications, some type of insurance products, if you will. But Brittany, I know when I talk about these items, I always like to go back to, self-directed IRAs, how does that work for in the tax purposes, and how does that come together for people, if you wouldn't mind? Because I know it is a
Sure.
retirement vehicle for us, for people that we're adding to more and more.
Yeah, I look at it as it's one of the many tools in an arsenal that somebody can consider and use or not use. But it is, as Erica mentioned earlier, a retirement account that allows for, I guess when we think about the traditional retirement account IRAs, 401ks, and what we, like Erica said, what we typically invest in, a lot of times the misconception was just that we were always limited to stocks, bonds, mutual funds, anything that was, you know, publicly traded in a tax deferred or tax free account. But the self-directed IRA is kind of an offshoot of that that allows for a more diverse array of investment choices. So it's typically going to be focused on private investments. So you might have, as Erica said, your Fidelity, you know, brokerage account, your Fidelity IRA, but you can also have, in addition to those things, a self-directed IRA that would enable you to also further diversify. So we look at the market and we look at, especially all the things that are going on now, so much volatility, right? So much fluctuation. And if we have all of our eggs in that basket, it could be kind of scary. Now, for those that are looking maybe more long term, might not be as scary. As you said, over, you know, decades, the general rate of return sounds like it's been pretty decent. But if we're looking to further diversify or hedge against some of that volatility in different types of investments, then alternative investments can potentially do that. They're typically more geared toward long term, and they tend to be not directly correlated with market performance. Like real assets, like real estate, Erica mentioned, you know, like natural resources, those types of investments tend to bode well during inflationary periods too. So expanding the investment holdings to include things like that in general can help. And then doing it within an IRA, which a self-directed retirement account would allow, additionally provides you those tax benefits. So as you mentioned, some of the different ways you can think about, you know, tax now, tax later, or not tax. Self-directed IRA is going to either give you a tax me later, tax deferred status, depending on the type of self-directed IRA you choose. Or you can have a self-directed Roth IRA, which is going to be all my earnings grow tax-free. And it, like you said, after 59 and a half, when I take my withdrawals, they're completely tax-free. So it's being able to invest in those types of things, and then also having the tax benefits of being able to defer or eliminate the burden on those things. And I think for certain individuals as well, they may have personal interest in these types of things, like real estate, for example. You know, a lot of people do have full-time jobs, but maybe, you know, real estate on the side. Like, for example, I have a rental property that I own with my sister, and in addition to my job. And so I'm not per se an expert, but I do have some experience in real estate investing. So I think there are a lot of individuals out there that would be interested potentially in doing something like that, or investing in some of the other things you can do, like investing in private companies, especially if someone is passionate about social investing, impact investing. There's a lot of opportunity and a lot of growth in that space now. People can put their dollars into meaningful causes, and then there's financial benefit as well. So there's a lot to think about there, but that's essentially how that type of account might work in terms of fitting into a larger plan.
No, because I think when we see here, as we start to develop even more portfolios, right, for clients, that diversification is imperative. Okay, and when I say that is the one thing we've talked about even early this morning, and what we've seen so far. Yes, the stock market is a big deal, but the one piece is the commodities market. It's still an investable asset out there, but the commodities market has gone through the roof today. Okay, so that's that counterbalance that we've seen, that we always like to see in that portfolio, because as certain assets perform well here, some may not perform well here, and that's fine. But in contrast, as you said, in high inflationary periods, things like that, there are other assets that can help, can either withhold or at least grow a portfolio to even another length. Because at the end of the day, we're just trying to get to retirement and say, how much do you need in retirement? That's the basic and really only question. I don't know what everyone may need. That's why we have to have that conversation. But if my assets in my portfolio, whether it be real estate, commodities, bonds, stocks, whatever the case might be, if all of that together gives me a check or gives me checks that total that number, you win. You win. That's it. And as long as that's above the amount that you want, you win even better. I look like a genius then, right? We do this. We do this in the sense of it's just the number that we're trying to get to say, can we afford once all the activity that we've either drummed up from the actions that we do are giving us what we want? At some point, we're not going to want to do the same thing for the same amount of speed. That's just, it's just the body will eventually give. And having a diverse portfolio with elements like the self-directed, with elements such as the IRAs, the Roth IRAs, the insurance products and things like that, allow you to say, okay, I'm building it and we're here and I can fight against inflation. I can fight against market increases, market decreases. I can do that in a systematic way with folks such as yourselves, folks such as myself, and say, okay, I'm comfortable where these avenues are taking me, because at the end, it's just retirement and it's just a number.
Yeah, I think these conversations have become even more important than ever too when we look at the retirement landscape versus what it even was like 20 or 30 years ago. Because a lot of times it was like in the bag for people, right? They would just, work for the same company for 30, 40 years. They had a pension, they had Social Security. So there wasn't a lot of like this being so top of mind with the onus on us to figure out like, oh my God, how am I going to bridge this gap? Like that gap, which is what you're saying, I think is where am I now versus where do I need to be to like sip margaritas on the beach or do whatever it is that you want to do. Now it's a little, in my opinion, scarier because our generation, a lot of these newer generations aren't going to have enough. They're not going to either not going to have Social Security or not nearly enough to rely on. And pensions are really hard to come by these days. I don't know who's even offering them anymore. Some like municipal employers and there, but most of us are just relying on like 401ks and our own investment decisions. So being able to have these conversations is super important, and having them hopefully early on, because we need to be more involved in the decision making for our own financial wellness, and that financial literacy is critical to be able to do that. And I guess one point I just want to clarify on the self-directed IRA side is with the self-directed IRA, the account holder truly chooses their own investments. They have the freedom to, if they want to invest in real estate, for example, pick that property down the street that they want to buy in their IRA. Or if there's a particular fund they're interested in, they can just go out and, seek a particular investment without necessarily having to choose from like a platform, because there aren't as many boundaries when we're looking at alternative assets. There are so many different unique and creative options. So there is a lot more decision making involved in that too. And that's why I wanted to kind of connect those dots there too, because certainly someone could be working with an advisor like you to kind of have the discussions about, okay, if I want to invest in alternative assets, maybe what do we want to consider? But they do have a lot of say in terms of exactly what they're going to choose to do as well.
No, and I think that's the key point, right? That today, out of any other time in history, it is a little bit scary, because that three-legged retirement monster was a pension, Social Security, and it might have been the simple savings that you did put together, but it was typically those pieces. And now, today, it is on us. It is on us, and it is on us to make sure that whatever vehicle it is, that it has the ability to have options as opposed to limitations. if you will, right? That's important because when we start the phases of, I call it planning, right? For retirement, I just call it planning. You start with having that conversation. What's out there? What can I do? What can't I do? And then you start the accumulation phase, right? You start placing the assets that you have together and you start growing, you start doing things. And that's going to take some time, right? Typically that accumulation period in history for any person, it's going to be anywhere about 20 to 35 years. It just depends on who you are and when you started. But we're getting ready from the planning to accumulation to now we're going to get to ready for the preservation. I'm getting closer to my date, right? And I don't want to peel the world back, but I want to make sure that where am I at toward the target, whatever the number is, and now what do I have to do to start reallocating with no limitations, as you were saying, right? With no limitations. But that period's going to start anywhere between 7 to 10 years as you inch toward whatever retirement date you are looking at. Because I agree with you, Social Security for us, a lot of people think 62 is that Social Security right age where you can start to get Social Security, and that's fair. But you are getting it at we don't call it a penalty, but you are taking early withdrawals from your Social Security benefit if you take it there. Typically, it's 67. I think for many of us on the phone and things like that, it's going to be closer to 70. Right? They're just going to keep inching that age up where that moving target. I may never get to that part. I hope that I do, but I just may not get there, if you will. And as you're inching toward that, as you're working through the distribution phase, those pieces become very important, right? The Social Security, the other buckets, the IRAs, all that stuff starts to come in together to formulate what I'm doing. I'm now at distribution. I'm now receiving what I want. I'm hopefully putting there. I always throw the last phase of life right now because the hope is if it's done all correctly, hopefully, you've done it with advisors, you've done it with the tools that are out there to give you no limitations, there is then potentially that passage of wealth that will occur to the next generation. And whomever that may be, however that is a true thing that we're getting into more and more in today's world where there is that passage that's occurring. And that's important because now it's not a reset, but it is providing whatever's there to the next generation to see how they can make it grow even further along. And so understanding the limitations of the products, understanding stocks, the bonds, the mutual funds, the ETFs, all that good stuff, working with professionals such as yourselves and myself is really crucial to say, it doesn't matter what you have, guys. We just need to have the conversation to see where we're trying to get to, is all I'm getting at. We got to start somewhere. And once we start, sky's the limit in my mind, in my book.
Makes sense.
I know we wanted to talk briefly, and I want to make sure that I get this one item out because it was something that's always, it sticks in my head only because of what's been going on today. And I just want to take that minute to say, we've all heard of this potential rule, but it's called the Rule of 72. It is very, very basic. It's very, very, very basic. But let me just explain it to you really quickly. If you took whatever interest that you're actually getting on something, 4%, let's just do that, and divide it into 72, that's how long your money is going to double. It's going to take you about 18 years for your money to double. So you can kind of understand, hey, Dominic, I'm getting 1% return, 72 years, 4, 18, 7, closer to 10, right? It kind of helps you understand that simple rule when it comes to, well, wait a minute, why should I do that? What would happen to my money? That rule of 72 is going to tell you how long that 10,000, 20,000, 50, 100,000 is going to double. It seems very simplistic, but it is something that I try to make sure that many of the clients that come to the door do the rule of 72. I'm already doing it for myself, obviously, when you're in here, but do it for yourself when you're talking to others. What are we looking at? Because maybe I need to have, during my time horizon, a little more money today than I do later. So I want to make sure that, is that in line with what I'm trying to do? It's a simple rule. You've seen it. It's almost very elementary. But the truth is, I don't understand why nobody uses it. I just don't. I don't get it because I run into clients that said, well, it was only going to get me 2%. You do understand then how long it was going to take you to get the money to return double back to you at 2%. Oh, I did not know. this rule exists for a reason. It's something that we should all be utilizing anytime you're looking at any type of investment. I just wanted to get that out there because I've seen it now today, because I see a lot of people moving to cash. Cash is earning you 0, or I'll give you a 0.01 just because I'm real generous at any bank. Okay, just because it's not doing anything for you. Okay, so let's be very clear. You put it to cash, it's not going to get you what you're looking for. It gives you security, but it's not.
Comes at a cost.
It comes at a
Everything comes at a cost, I guess.
and it comes at the cost of purchasing power, and especially today in a high inflationary period, purchasing power, purchasing risk is very important. We've all bought milk recently. I'm paying like, I don't know, paying almost 3 something now for milk here, where I paid maybe $2, and this is not 80 years ago. We're talking about last year. I was paying $2.50. Now I'm paying $3.80 for the same gallon. It's called inflation. Okay. But I know we wanted to kind of go into a little bit of. I just want you, when it comes to not prohibited, but basically, can you elaborate on kind of the process and the timeline for setting up a self-directed? Because I don't know. I personally don't know what that takes. I know for me, setting up an IRA or Roth IRA or even an insurance product, depending on your health, it takes only about a couple of weeks to maybe 3 weeks. And that's really because of insurance products. And hey, we had a holiday between setting up paperwork, and I left it on my desk on Monday, and I forgot that the holiday was on. That holiday was that day, so nothing went through. Can you help elaborate on that a little bit for me?
Sure. So the process for the self-directed IRA, I would say it probably take around, the timeline would be similar, but probably a bit longer. And the reason for that is that individual involvement we were talking about and all the choices that need to be made. So it's good to have those ability to make the choices, but of course then it's going to involve just a little bit more customization. So typically if someone is opening a self-directed IRA, they already have a sense of what they would want to invest in. Because as we said before, it's fully, by self-directed, we mean if someone opened a self-directed IRA and dumped a bunch of cash in there and did nothing, then nothing would happen. Yeah. So it's still going to require the account holder and or their advisor to make some decisions about what are we going to do with these funds, actively investing them. So usually if someone's going to move forward to set one up, they have something in mind that they want to do. Kind of either they have a specific investment they're ready to get started on, or they're ruminating on, real estate or, private companies they're looking at or something. But the first step is always going to be to just establish an account. So we typically have a conversation with each individual to understand their circumstances and make sure that they're educated on the types of accounts available. Because as you said before, self-directed IRAs are self-directed in the sense that in terms of what you can invest in, but you can have any of those account types still. So that traditional tax-deferred IRA, Roth IRA, and then for business owners, you mentioned earlier a SEP IRA. There are simples too. They're not as common, but they're there for small businesses. And then there are also other types of qualified retirement plans, like 401ks for a business owner. If they could have a solo 401k, if it's just them on their plan, could have a profit sharing plan, some other types of plans that are still out there with some more flexibility. Those can also potentially be self-directed. So it's important that we have these conversations to understand the individual's position. Are they working? Do they have a corporate job? Are they W-2 employee? Are they self-employed? So they know they have these choices. And then they can decide what account type is best for them. But once they do make that decision, whether it be sufficient talking to us to understand that, or they maybe want to consult with their tax advisor, or perhaps a financial advisor as well, they then would complete an application. So just filling out an application, relatively straightforward, the types of information that you would normally, put in there. beneficiaries. Same thing with self-directed IRAs. You can select your beneficiaries, and then if something were to happen, any assets in that account would then pass to those beneficiaries and become inherited. So self-directed IRAs work similarly there. But once they've submitted an application, it takes a couple days, maybe if anything, to get the account open. And then it's a matter of funding the account. And that's usually the bigger piece that could vary in terms of the timetable. And I'm sure, Dominic, in your experience too, you've seen if you're trying to get funds into your oversight, it's always like pulling teeth for another institution to let go of it.
Correct.
So there can be delays in those processes. So if someone, for example, had an IRA at Schwab, they wanted to open a self-directed IRA, they could take some of the funds from Schwab and transfer from that IRA into the self-directed IRA with no tax implications or any reporting or anything, which is nice. But of course, we have to request the transfer from Schwab, and they have to go through their own processing time. So, I've seen it literally take as little as a couple days or a week or two if there are delays in processing, or they're pushing back or dragging their feet or whatever it might be. In addition to transferring from an existing IRA, we mentioned 401ks too, or 403bs, or other types of employer plans. So if somebody has one of those, and 9 times out of 10, if they've left that company and they're now separated service from that employer, usually that account, which we then consider to not be active, they can move. They have the ability to take funds out of that old plan, and they can roll that over. So do a rollover into a self-directed IRA. So that's another way to fund an account. And of course, there are contributions that can be made out of pocket. Different types of accounts the IRS sets limits on in terms of how much you can put in per year. If you're a business owner, some of those accounts designed for business owners are going to allow for a bit more, perhaps more potential there to contribute out of pocket. But we would essentially work with each individual and then have some interfacing with the other institution to get that process done. And as I mentioned, it could take anywhere from a few days to maybe a week or two. And then the final step in the process is, of course, identifying an investment and making an investment. So that part does involve as well some paperwork and a little bit of, I guess, customized review. Because as I mentioned before, if someone wanted to buy like 123 Main Street down the road, that's not necessarily an investment that any custodian or any institution has held before, right? It's just a unique property down the street. So that means that if somebody wanted to do that with their IRA, they would need to submit to their self-directed IRA provider, like Next Generation, for example, some paperwork directing us to make the investment on behalf of their IRA, and then also supporting documentation so that all the paperwork that would normally be involved in a real estate transaction is still getting executed, but it's being done in the name of that IRA versus that personal name. Yeah. So that's what enables it to hold its tax advantage status. And the vehicle through which the investment is made and all the funds flow back and forth is the IRA, rather than a personal taxable account. So there's a review that self-directed IRA custodian will do on all that paperwork and all that documentation, looking for accuracy, also looking for compliance with IRS guidelines. We didn't get into it in today's discussion, and that's okay, but there are some rules and regulations and some restrictions on who you can and can't invest with a self-directed IRA. The IRS looks at certain relationships like family members and things like that, and there's some that you can't invest with using your IRA. So that's important to understand as well. But the custodian reviewing the paperwork will also look to see if any of that is glaring, and if there's a situation like that, they would halt that investment, go back and have to reevaluate that. But at the conclusion of the review, which takes several days, then the funds would be deployed out of the IRA to that particular investment, whatever it might be. And then as that earns or yields a return, whether it be, if it's a rental property, then rental income gets paid back to the IRA. If it is, a flip on a property, then obviously proceeds from sale go back to the IRA. If it's a like private equity type investment, maybe then dividends are being paid back. If the IRA is doing private lending, then interest and principal are being paid back. So all of that, what would typically be your earnings, just as if you had a, I guess a regular IRA, I won't say
Regular,
regular,
right? Yep. Mhm.
the classic idea of what we think of. Same thing, everything flows in and out of the account. It doesn't touch anyone's hands personally unless, as you said earlier, they were ready to start taking withdrawals for retirement purposes. And if they were to do that, they would have to be taking them directly out of the IRA. So a little long-winded of an explanation, but that's the whole process. And generally speaking, we like to say conservatively, if someone has not established a self-directed IRA yet and they've never done this at all, 4 to 6 weeks just to be safe. Especially if there's an investment deadline in mind, we try to manage that, and it would probably not be wise to go through the steps of preparing for an investment and then like 2 weeks out try to open an IRA to do it. Usually best to just be proactive and understand this first. And then if someone is committed that they definitely want to do something, to get the ball rolling on the setup process.
No, that makes complete sense to say, okay, look, don't come to me 2 days before the deal. That's all just don't come to me because it's never going to work if that's what you're trying to do.
Yeah, it's the beauty of it being, there's obviously pros and cons to everything. The beauty of this is that there's that, like you said, less limitation, less restriction, more ability to be creative and do some new and different, unique things. But obviously with that, then there's not the same level of standardization, automation that you're going to get if you're, on your Fidelity app, clicking a button to buy stock or whatever. It's not the same process. So that's usually the biggest hurdle that we face in terms of expectation setting and educating people to kind of mindset shift when they're thinking about this strategy versus the traditional way of doing things. You're right, it's not going to be a 2-day, completely hands-off thing. There is some more involvement there.
And I think that's important to, really understand for people, for myself as well, because everything that you do, we do up to that point, right? Because my conversation to put people into the assets would have happened as we're going through the transfer of the assets and things like that. But it's once we do that, that paperwork is done. It's done in one swoop. To your point, it could take time when I'm pulling assets from someone else to get them into my office. It could take some time, but that whole piece is done. And then we start, okay, well, now where's the portfolio? Here's where that's at. But it is done. Okay, well, now you can go to your app. You can do this. That's what a lot of people like to see at times. So I understand that it's not traditional, but it's still doing the exact same thing. It's earnings. Earnings are going to get funneled back into the IRA at the end of the day. Dividends are going to get funneled back into the IRA, the self-directed IRA. Same thing I would say. You're going to get you're going to get your dividends. You're going to get your earnings. It's all going to be there. It's going to be on one nice sheet for you if we can get it all there, that you can click on a button to go see. Some people like it, some people don't. But at the end of the day, the goal is to still have the dialogue that you're expressing here. So let's walk it through to make sure we're all on the same page at the end, as we approach the objective, which is either buying the land, being a private lender, or putting just other assets into there. Obviously, from Schwab to anybody else, you can do that as well. I know we have some time, and we have a little time left, but I want to make sure that one thing that we get to is that litigation piece, which is basically, hey, what pending litigation, what pending items are out there to say? And I got to be honest with you, it kind of goes back to the beginning of the meeting where I just don't know. We've had a lot of changes in the industry in particular. One of the bigger items that's hopped up recently is where 401ks and 403bs have to have a true another form for myself. I have to fill out a completely brand new form when it comes to transferring those assets and making sure that my clients are fully aware, number one, what that asset is, number two, what the expenditures are from the previous asset to where I'm actually charging, and number three, did you come to this conclusion either with the advisor, or did you come to this conclusion without the advisor? That new document is brand new now. Congress and senators have actually said, hey, we're not going to implement all of this or let me say it this way, we're not going to monitor this for this coming year, but this was the new desire to make sure that it was done. Actually, it was supposed to be done this year, I think June of this year in particular, but now we're getting a postponement. But we went ahead and activated it as if it were already implemented. Have you had to do some changes in the pending litigations and pending things that are going on? Have you had to make any changes so far?
So we haven't had to necessarily make any concrete changes, but there's a lot that we've had our eyes on.
Okay.
One of the things that there's been a lot of talk about on the alternative asset side is cryptocurrency. As Erica mentioned earlier, cryptocurrency can be held in a self-directed IRA, but there's not a lot of direction from the IRS or Department of Labor in terms of what you can and can't do, how it's classified, how it really should be taxed. So people are doing it actively, and we're able to hold it, and we offer a couple different options for that. But we're expecting that there's going to be some sort of communication from the government about additional regulation. Like you said, there's a lot we really don't know, but apparently there is an executive order forthcoming. We think it might be out soon. We just really don't know.
You said the Department of Labor has done a lot of information, a lot of executive orders, but not today is what we keep hearing. Okay, well,
yeah.
And it could change, by the way.
Yeah, it's we'll get back to you on that kind of thing. So there's a lot of rumbling on that side. And then last fall, of course, there were certain provisions of the Build Back Better Act that had implications for self-directed IRAs. One was, and some of these I'll note have been stricken from the bill. So not to say that they're necessarily going to happen, but just there was a lot back and forth related to, one was a cap on total IRA assets, which actually I think is going to go through, but it's not going to be implemented for some time. And I think it's like $10 million. So it's probably not going to impact most of us.
I think so.
It's out there. So if anyone's feeling really daring, but yeah, it's out there. So that one looks like it is going to have some implication, but the other one that was stricken was the more concerning one that people were really talking about late last year, was they were going to basically prohibit any investments in an IRA that were exclusive to accredited investors only. So that would have had implications for a lot of investment sponsors and a lot of these fund managers, because many of them only work with accredited investors.
Correct.
And many accredited investors use self-directed IRAs for the tax benefits, as you can imagine. Mm-hmm. So that would have really limited their resources from a capital raising perspective. But it turns out that did not go through. So as of now, that's not happening. There was one other. What's that?
We haven't seen any real win behind it after it was kind of, I don't want to say shut down, but after it was really brought up to say, do you understand the implications of what that would do to many of the accredited investors out there?
Right. Yeah, I think there was a lot of pushback on exactly, as you said, just making sure that there was an understanding of exactly what that would mean for people, rather than the intentions behind it may have been good, but there was a lot more involved than they realized. But other than that, I mean, a lot of the other stuff is still on the table. It's still for negotiation. So all we can do, like you said, is just continue to, as we receive information, make sure that we're sharing that with the communities that we work with. So
all of this information is always just meant to senators, Congress, and DOL, the Department of Labor, excuse me. They're all trying to obviously do with the right mindset of the investor. They're trying to protect the investor and make sure that we're not doing anything that could harm them. So I understand. I think we all understand that concept. It's just when the practicality, the implementation of it, you need to have worked the process to know that may not exactly work. And that's why we've seen this hold up to say, not just yet, maybe we need to take a look at it, or we actually are definitely pulling this out. This won't work at all.
Right.
But there is more. There's more to come on. I thank you, Brittany. I thank you so much for the time. I know we're getting close to it. I don't know, Erica,
Yeah.
were there any questions or anything like that?
We don't have any questions, but in lieu of questions, there are a couple of things that I do want to get to. One of them is upcoming events and some content I'd like to share. So obviously, we do webinars once a month. New webinars will go up on our events page on the website as they're announced, but we are hosting in a couple of weeks a networking session. So on March 9th at 10 a.m., we're going to be doing a Caffeinate and Connect early morning networking session. So that's for anyone to join. You can join to meet with financial professionals like Dominic. You can join to meet investment sponsors, other self-directed IRA investors, and of course, the Next Generation team, who are obviously available to answer any SDIRA related questions. But in addition to that, I do just want to make a note because we have, we did not get to the piece of the discussion on prohibited transactions. And that is a very important piece of the conversation. So I did want to share an awesome white paper that we have on prohibited transactions, very info packed. It covers everything you need to know. So if you're interested in downloading that, I'm going to be pasting the link in the chat, which I just did, to the upcoming networking session, as well as the prohibited transactions white paper. And for those of you that didn't get a chance to attend live, if you go to www.nextgenerationtrust.com, you can find all of our white papers under information and education. And then we have a dedicated tab for events on our top navigation, as well as on-demand webinars also under the information and education sections. So in lieu of questions, we do have some polling for those of you that are still with us. The purpose of this is really just to learn a little bit more about you and what you're interested in. So the first question that we have is, do you have any existing retirement or savings accounts? So I'm going to launch that poll now. Feel free to answer. As always, all of these polls are optional, so you don't have to answer, but if you wish, you may. And like Brittany was saying earlier, and like I was saying earlier, there's a ton of different account types, all of which can be self-directed.
I guess, Erica, I should add that if you went to defreezefinancial.com, there's some of the items that we mentioned that would be related to budget, related to financial literacy. You'll find them on my website as well.
Yes, and if I could actually ask a favor of you both, if you could paste your contact info into the chat as well, that way everyone has it.
Of course.
Sure.
And while they're doing that, I will end this poll. We'll share the results. It looks like a pretty healthy mix. We've got a lot of you in 401ks, traditionals, Roths, some in simple, solo Ks, and even some have an HSA. Okay.
Can also be self-directed, by the way.
Yes, health savings accounts and education savings accounts can be self-directed, which is very interesting. Not a lot of people know that. Our next poll is retirement account balance. So of any of the retirement accounts that you have, obviously give or take, what is approximately the amount in those accounts? I'll launch that one now. Right. I'll give everyone a couple more seconds. Okay. We'll share these results. So we've got 0 to 20K and 250 to 500K. So good mixes, but all of those you can definitely use towards self-direction. And our final poll is regarding investment interest. So what types of investments are you interested in? Like I said, we've got real estate, private equity, cryptocurrency, hard money lending, precious metals, also impact investing, and ESG investments. So if you are passionate about certain movements, certain causes, if there are investments available within those sectors, then those can be included in self-directed IRAs as well.
You see my eyes moving, it's only because President Biden is actually putting out some comments on what they're planning on doing in the US, so I apologize.
Is he just starting, did you say?
No, he's already started, but they're now talking about the sanctions and oil. He's going to open up the oil pipelines, it looks like, and they won't execute any sanctions just yet, is what he's saying.
Interesting. Okay, so we'll end that one and share the results. It looks like the majority is interested in real estate, which is definitely not a surprise. Most people are. But with that concludes our conversation for today. I don't see that any other questions came in. So if you'd like to get in contact with any of us, the information is pasted into the chat bubble. We have Brittany Melville, Brittany M at nextgenerationtrust.com. Our phone number is 973-533-1880 for those of you watching on demand. And Dominic DeFries, Dominic at DeFriesFinancial.com. His office line is 717-685-6279, and his direct line is 717-685-5751. And also his cell is 484-818-0035. So Dominic, thank you for joining. Brittany, as always, you're awesome. And we will see you on the next one.
Guys, thank you so much.
Thank you all. Have a great day. Thanks,
Bye,
Dominic.
everyone.
Good to see you.